Everyone is chasing the AI mirage right now, but the real trillion-dollar wealth is quietly being built in legacy, hardware, and unique data silos that the retail herd is completely ignoring. Hello, this is Warm Insight. Today, we're going to talk about tech's AI power plays and where real value hides. Leaving a like and subscribing is a huge help to us. To understand what is truly happening in the financial markets today, we have to completely change our perspective on what artificial intelligence actually is. Most people view artificial intelligence as a software product. They look at a chatbot on their screen and think they are interacting with a magical piece of code that simply exists in the cloud. But the reality is far more industrial. The global artificial intelligence race feels exactly like a new Cold War. And to understand where the smart money is flowing, we must look back at the original space race and the nuclear arms race of the 20th century. Back in the 1950s, when the Soviet Union launched Sputnik into orbit, it was not just a scientific achievement. It was a terrifying wake-up call for the United States, that they were falling behind in a critical arena of global dominance. This panic triggered a massive, unprecedented reallocation of national capital. The government poured billions into research and development, creating agencies like DARPA, which eventually laid the groundwork for the modern internet and GPS technology. The wealth generated from that era did not just go to the astronauts. It went to the defense contractors, the materials, scientists, and the engineers building the physical infrastructure of the space age. Today, silicon chips and advanced algorithms are the new strategic weapons. Nations are playing a high-stakes poker game, where artificial intelligence dominance is the absolute pot, and national security is the ultimate prize on the table. This is no longer just about corporate profit or beating a quarterly earnings estimate. It is about who controls the foundational technology of the next century. Governments across the globe are quietly, but aggressively pushing for domestic artificial intelligence champions. They are actively shaping global supply chains and aggressively manipulating talent flows. We see this unfolding right now in the form of severe semiconductor export controls. Nations are essentially placing an iron curtain around high-end processing power, treating advanced graphics processing units with the same level of security and restriction as weapons-grade uranium. Furthermore, we are witnessing massive state-sponsored research and development spending. China, the United States, and Europe are all fiercely vying for leadership. This intense competition means huge government support for key sectors through direct subsidies, massive tax breaks, and enormous research grants. This is not the free market at work. This is state-backed industrial policy operating on a global scale. Because of this geopolitical reality, controlling artificial intelligence means controlling future global power. We are seeing a fierce cutthroat competition for talent and physical resources, which directly influences where capital is flowing right now. One of the most overlooked aspects of this race is the sheer physical limitation of energy. The energy demands for training and running. These massive artificial intelligence models are climbing at an exponential rate. A single query to an advanced artificial intelligence model requires significantly more electricity than a traditional search engine request. When you multiply that by billions of users and thousands of enterprise applications, the strain on the global electrical grid becomes catastrophic. This undeniable physical reality creates massive new infrastructure needs, which is why the smart money is aggressively driving capital into utility plays, nuclear energy revitalization, and massive power grid investments. This global dynamic creates a solid floor under certain infrastructure investments, making them incredibly defensible. Everyone, regardless of which software company wins, the chatbot war needs these foundational layers. This international race is also fueling a massive wave of mergers and acquisitions, as companies scramble to acquire startups simply to secure their top-tier engineering talent and proprietary technology. Yet while the smartest institutions are securing the physical and geopolitical foundations of this new era, the retail investor herd is completely distracted by the noise. The real story is almost always hidden by the manic frenzy of the retail market. The herd is perpetually chasing flashy headlines, often completely ignoring the underlying fundamental mechanics of a business. A popular television pundit might scream to buy a specific trending stock, and millions of retail investors will blindly follow. This predictable behavior creates massive short-term price spikes, driven entirely by the fear of missing out. rather than any deep rational analysis. Right now, we are witnessing a phenomenon known as AI washing on a scale that is truly staggering. Companies across every single sector are desperately slapping the term artificial intelligence onto their legacy products, hoping for a magical bump in their valuation multiples. To understand the psychology of this herd mentality, we only need to look back to the late 1990s during the height of the dot-com bubble. During that era of extreme market euphoria, companies that had absolutely nothing to do with the internet would simply add a .com to the end of their corporate name, and their stock prices would double overnight. Retail investors, terrified of missing out on the internet, revolution, poured their life savings into companies that had zero revenue, zero viable products, and no realistic business model. They were blinded by the promise of a new technological paradigm and completely ignored basic financial realities. The exact same psychological phenomenon is happening today. Retail investors are falling for superficial branding. They are buying into the hype and completely missing the substance. This behavior is exactly like chasing a shimmering mirage in a scorching desert. From a distance, it looks like an oasis of endless promise and life-saving water. But as you pour your capital into it and get closer, you realize there is absolutely no real water, just the harsh, unforgiving sand of financial reality. They jump on any penny stock that includes the letters AI in its press release, a strategy that is guaranteed to lead to incredibly painful financial corrections when the hype fades and reality sets in. We must cut through this deafening noise and look at what the contrarian smart money is actually doing. Smart money acts exactly like the most successful pioneers during the 1849 California gold rush. When news of gold in the California rivers reached the East Coast, hundreds of thousands of people left their jobs, sold their homes, and traveled across dangerous terrain to strike it rich. They were blinded by the ultimate FOMO. But history tells us that the vast majority of those prospectors went completely bankrupt, died of disease, or returned home in absolute poverty. So who actually made the generational wealth during the gold rush? It was not the prospectors. It was the merchants. Men like Samuel Brannan, who famously walked through the streets of San Francisco, holding a vial of gold, shouting about the discoveries to whip the public into a frenzy. Brannan never mined a single ounce of gold himself. Instead, he bought up every single pickaxe, shovel, and mining pan in the region and sold them at an astronomical markup to the desperate prospectors. He became the first millionaire in California by providing the essential tools for the rush. Similarly, Levi Strauss built a global empire not by finding gold, but by manufacturing the durable denim jeans that the miners needed to survive the harsh working conditions. Today, the smart money is employing the exact same shovel and pickaxe strategy. They are not trying to guess which individual software startup will build the best artificial intelligence model. Instead, they are investing heavily in the companies that are selling the essential tools and infrastructure required for anyone to participate in the artificial intelligence revolution. A perfect example of this is the massive recent jump in Dell's valuation. To the retail herd, Dell is seen as a boring legacy computer hardware company from the 1990s. But to the smart money, Dell is the ultimate modern-day shovel seller. They are building the physical backbone for artificial intelligence by assembling the massive, incredibly complex, GPU-packed server racks that data centers desperately need. You cannot run advanced artificial intelligence without specialized liquid-cooled servers, and Dell is manufacturing that essential physical layer. Another incredible example is Okta, a company experiencing massive growth, driven by the demand for agentic artificial intelligence. As artificial intelligence models evolve from simply answering questions to actually taking autonomous actions on behalf of users, the need for rock-solid, bulletproof identity verification becomes critical. If an artificial intelligence agent is going to access your bank account or send corporate emails, the system needs a flawless way to verify that identity. Okta provides this essential security infrastructure. Similarly, the recent $40 million funding round for a niche software company called H1 proves the incredible value of unique, defensible data. Artificial intelligence models are only as good as the data they are trained on, and the models are rapidly running out of high-quality, publicly available internet data. The next massive frontier of value is proprietary, locked-down data silos. Investing in this space is like listening to masterclass jazz improvisation. The best investors do not just follow the standard sheet music that everyone else is reading. They look for high-value, unexpected riffs. They are looking for companies that are quietly enabling the artificial intelligence revolution from the shadows, not just the ones loudly participating in the spotlight. This is where the real sustainable alpha is actually generated. Let us look at the institutional market dashboard to see this flow in action. We are seeing artificial intelligence demand surge, which causes an absolute explosion in the need for graphics, processing units, and specialized servers. This directly benefits foundational hardware companies like NVIDIA and Dell. As this hardware is deployed, the need for specialized artificial intelligence, software, and unique data becomes paramount, allowing companies like Anthropic, Okta, and H1 to thrive. This creates a powerful cycle, where entirely new tech market leaders emerge, completely bypassing the superficial consumer applications that retail investors are obsessed with. To map out the future, we must examine both the institutional bull case and the institutional bear case for this massive technological shift. The bullish scenario centers on the accelerating and pervasive integration of artificial intelligence across absolutely all sectors of the global economy at a pace that far exceeds current market expectations. This is similar to the massive network effects we saw during the British railway mania of the 1840s. When the railways were first introduced, people severely underestimated how fundamentally they would alter commerce, communication, and human geography. The institutions betting on the bull case anticipate a continuous, wildly robust demand for underlying infrastructure. This includes advanced semiconductors, high-bandwidth networking cables, and massive specialized data centers. This insatiable demand will drive sustained, long-term revenue growth for the foundational technology providers. Furthermore, the development of increasingly sophisticated artificial intelligence models will unlock entirely new applications and operational efficiencies for massive global enterprises. This will lead to significant measurable productivity gains and a massive new wave of software and service innovation. This widespread global adoption, coupled with ongoing mind-bending technological breakthroughs in adjacent areas like quantum computing and highly efficient edge computing, could logically propel valuations even higher, as the true, undeniable economic impact of artificial intelligence becomes deeply embedded into global commerce. It will fully justify the premium pricing for these undisputed market leaders. Conversely, we must remain brutally objective and examine the institutional bear outlook, which highlights several massive potential pitfalls that could easily derail current growth trajectories and deflate these highly elevated valuations. Overvaluation remains a severe systemic concern across the market. Many companies are currently trading at astronomical multiples that completely bake in absolute perfection. They are priced for a flawless execution over the next 10 years, leaving absolutely zero room for error, economic downturns, or execution stumbles. Furthermore, regulatory headwinds present a massive, looming threat. Governments are notoriously slow to understand new technology, but when they do react, they often overreact. Severe regulations concerning data privacy, artificial intelligence ethics, copyright infringement, and antitrust legislation could violently slow down the pace of innovation or impose cripplingly expensive compliance burdens on these companies. We must also consider the terrifying prospect of geopolitical tensions, instantly impacting the delicate semiconductor supply chain. If a conflict were to disrupt the flow of chips from Taiwan, or if aggressive, new export controls restricted access to critical global markets, it would pose a catastrophic systemic risk to the entire sector. Finally, there is the risk of enterprise disillusionment. If the actual real-world return on investment for these highly expensive enterprise artificial intelligence solutions proves to be slower or significantly less impactful than the massive hype anticipates, corporate budgets will be slashed. This disillusionment phase would lead to a brutal, unforgiving market correction, particularly punishing those companies whose multi-billion-dollar valuations are driven entirely by speculative future potential, rather than proven, cold-hard profitability. Navigating this treacherous but incredibly lucrative landscape requires a disciplined, strategic approach. This brings us to the Titan's playbook for generational wealth building. First, we must understand the generational bargain currently at play. The current market sentiment is resting on a highly precarious balance. It is characterized by an overwhelming, palpable wave of greed, fueled by the genuinely transformative potential of this technology. Yet this greed is underscored by a subtle, creeping anxiety and a profound fear of missing out that historically precedes severe market recalibrations. Investors are aggressively, almost blindly chasing the perceived winners, driving valuations for semiconductor giants, cloud providers, and data companies to unprecedented, dizzying heights. This speculative fervor is not entirely unfounded, because the technological shifts are very real, but it has undoubtedly created dangerous pockets of extreme irrational exuberance. Beneath the shiny surface of these rising stock charts, there is a deep structural anxiety about the long-term sustainability of these valuations and the high probability of a sharp, sudden correction. Therefore, deploying your capital right now requires an ironclad, disciplined methodology that focuses strictly on the tangible enablers of the technology rather than the speculative lottery ticket ventures. We highly recommend utilizing the 70-20-10 asset allocation seesaw. This strategy dictates allocating 70% of your portfolio to robust, foundational stocks and exchange-traded funds, 20% to safe income, generating assets to provide a buffer against volatility, and maintaining a strict 10% in absolute cash. That cash position is your ammunition. It is what allows you to act aggressively and buy high-quality assets at a massive discount when the inevitable market corrections occur, and the retail herd is panic selling in pure terror. For the 70% equity allocation, we recommend concentrating heavily on ETF sectors that provide broad, diversified exposure to the foundational infrastructure powering this revolution. Specifically, you must consider semiconductor ETFs, which capture the absolute core processing power behind every single algorithmic calculation. Cloud computing ETFs offer incredibly broad exposure to the essential data, storage, and immense processing backbone that the entire industry relies upon. Additionally, exploring specific data center, real estate investment trusts, or broad infrastructure, focused tech ETFs can provide a highly diversified, lower volatility play on the massive physical expansion required to build these modern marvels. You must strictly avoid thinly traded, highly niche, artificial intelligence ETFs that lack meaningful diversification and are often stuffed with highly speculative, completely unprofitable companies. Prioritize your capital toward companies with deeply proven revenue streams and crystal clear, undeniable pathways to monetization. We must also employ the global shield strategy when considering your exposure to United States markets versus international markets. It is clear that the United States currently holds a massive, dominant lead in the artificial intelligence landscape. The U.S. is the undisputed king of foundational academic research, complex chip design, and massive-scale cloud infrastructure. Therefore, a massive primary allocation to U.S.-centric technology, ETFs, and individual foundational stocks is absolutely essential for capturing the core growth of this era. However, completely overlooking the international markets would be a massive strategic failure. Europe, while certainly lagging in raw computational power and bold innovation, is making massive, calculated strides in artificial intelligence ethics, regulatory frameworks, and highly specific legacy industrial applications, potentially offering deep value plays for the patient investor. Meanwhile, Asia is the absolute beating heart of the physical supply chain. Countries like Taiwan, with its unmatched, almost magical semiconductor manufacturing prowess, and South Korea, with its dominance in memory chips and advanced electronics, are the critical, indispensable components of the global ecosystem. Without Asia's manufacturing capabilities, the entire American software ecosystem grinds to a complete halt. Therefore, a truly prudent, sophisticated strategy involves a massive, heavy U.S. core, carefully supplemented by highly targeted strategic international exposure. Through global technology, ETFs, or very specific country ETFs that possess strong, enabling industries, this global diversification inherently mitigates risk, while capturing a much broader slice of the massive economic pie. Finally, we must master the survival mechanics of investing in highly volatile, paradigm-shifting markets, in a sector characterized by both immense life-changing opportunity and terrifying stomach-churning volatility. Dollar-cost averaging is an absolute, indispensable prerequisite for risk management. Human psychology is biologically wired to fail at investing. Our amygdala reacts to financial loss with the exact same pain receptors as physical injury, causing us to panic sell at the absolute bottom. Conversely, dopamine drives us to buy at the absolute peak of a euphoric bubble, instead of attempting the impossible task of perfectly timing the market's unpredictable peaks and troughs. Consistently investing a fixed, predetermined dollar amount at regular set intervals completely smooths out your average purchase price over time. It bypasses your flawed human emotions. This mathematical approach significantly reduces the devastating impact of short-term price fluctuations, and is particularly valuable in a sector where massive, rapid price swings are a daily occurrence. Furthermore, true, robust risk management requires setting crystal clear, unemotional stop-loss orders on your individual, speculative positions to ruthlessly protect your capital against severe structural downturns. You must maintain a highly diversified portfolio that extends far beyond just the technology sector. Do not make the amateur mistake of concentrating your entire net worth into a few high-flying, incredibly volatile stocks, no matter how compelling their future prospects might seem on a spreadsheet. In the brutal arena of the financial markets, capital preservation must always be your paramount, overriding consideration. To put this into immediate action, you should initiate or steadily add to your positions in broad semiconductor ETFs during any market-wide technology correction of 5 to 7%. Viewing these temporary dips as massive, rare opportunities to acquire the foundational infrastructure of the future. At a steep discount, you should also begin meticulously building positions in cloud computing and data center infrastructure ETFs, paying extremely close attention to the earnings reports from the major cloud providers to verify that massive capital expenditure is actually flowing into these physical assets. Conversely, you must absolutely avoid the critical wealth destroying mistake of chasing highly speculative, deeply unprofitable companies whose multi-billion-dollar valuations are based purely on buzzwords, futuristic promises, and a complete lack of near-term revenue generation. These story stocks are always the very first to suffer devastating, unrecoverable corrections when the market sentiment shifts, or when their promised technological miracles fail to materialize. History consistently and ruthlessly shows that transformative technologies, from the physical railroads of the 19th century to the digital internet of the 20th century, experience massive cycles of immense intoxicating hype, followed by speculative bubbles, devastating crashes, and eventual healthy consolidation. While this current technological revolution feels utterly unprecedented in its speed and scale, its underlying market dynamics perfectly echo those past historical eras. In every single one of those past revolutions, the foundational infrastructure players, the ones selling the shovels and building the tracks, consistently emerged as the true long-term winners, generating massive generational wealth, even as thousands of early, highly speculative ventures faded entirely into bankruptcy and historical obscurity. In this high-stakes game, incredible patience and a ruthless, unwavering focus on intrinsic fundamental value have always been the intelligent investor's steadiest and most profitable companions.